Hello and welcome to Livewire Markets. My name is Chris Conway. With the $45 billion AT1 hybrid market being phased out, investors are going to be looking for some income opportunities to fill the gap. Joining me today is Cameron McCormack from VanEck, who's going to be talking to us about some potential solutions. Cam, it's nice to see you again.
Thanks for having me, Chris.
Now, Cam, as you would well understand, the focus for Australian income investors has always been on getting a good yield. It's about to get a little bit harder, of course, with the phase out of the $45 billion AT1 hybrid market by 2032. So let's just set the scene a little bit before we talk about some of the solutions. Why did this happen?
Yeah, it's an interesting, announcement that APRA made at the end of last year. So the crux of it is that they're going to phase out ASX hybrids over a 7-year time frame, starting next year, January, and then ending in 2032. Now, the key, premise for why they've announced ASX hybrids to be phased out is that they don't see them as behaving as intended. And one of the key reflection points was clearly the Credit Suisse scenario where AT1s were written off and ultimately they didn't act in a going concern event. And they've looked at previous, events where governments had to step in. And the premise is that they wanted to streamline essentially the capital stack for banks. And that ultimately was the reason why they decided to phase out ASX hybrids.
Cam, so I want to ask you what you make of that. Obviously, VanEck sits in the middle of the regulator and then, of course, the end investor. The end investor we know likes these products, but the regulator, for reasons that you just spoke about, has deemed that they're not appropriate anymore. What do you make of it as someone sitting in the middle of those two arguments?
Yeah, it's an interesting decision they've made, given it is the first of its kind globally. So Australia is really going to be the only regulated developed market without without hybrids in the capital stack. So it's very unique in that regard. And in doing so, what they're doing is they've told the banks they need to replace their ASX hybrids with a combination of subordinate debt, which sit one notch above in the capital stack, and also common equity on below. And I think the other interesting point as well is that it's over a 7-year time frame. So clearly they want to try and, make this transition as orderly as possible. And what we've seen recently with the announcement is that the banks have actually front-run that transition. So we've seen a range of ASX hybrids be called so far, and they haven't reissued ASX hybrids on the back of it, despite it not officially starting until the start of next year.
Cam, whenever there's a seismic shift in markets, as we know, it creates, yes, sometimes problems, but it also creates opportunities for investors. What are you seeing on those two fronts?
The key challenge for those that do like ASX hybrids is that, that they do offer quite an attractive yield, around 5.5%. And one of the key reasons why a lot of, particularly retail investors, like them as well, is that they did provide franking credits. And that's quite unique, again, in sort of the context of, Australian investments. With ASX hybrids being phased out, investors are going to have to look at alternative asset classes. Now, they are very wide-ranging when you think about not only Australia, but also globally what, investors can access. And with certainly ETFs as a vehicle, the ability for investors to access a range of asset classes is certainly at the fingertips.
Cam, no doubt we'll talk about some of the solutions shortly, but just one other question that I wanted to ask is around the fact that VanEck has been adding some duration lately and has been thinking about adding duration to the portfolios in the current environment. I just want to ask, why is that important and what's the thinking there?
Yeah, it's an interesting sort of, balance. Certainly when you think about not only, duration, so interest rate duration, but also credit spread duration. Mm-hmm. So when it comes to interest rate duration, we know that if you think about the environment we've been over the last sort of few years, central banks have had to increase interest rates quite substantially to obviously tackle inflation. We've started to see that come through, thankfully. Easing cycles both in Australia and globally have commenced, and they're likely to continue. And what we've seen recently with some of the uncertainty around, obviously, the impacts of tariffs, rising geopolitical tensions, is that we've seen the long end of the curve, so the 10 years, both in Australia and the US, come off, but they have sort of stayed above that 4% range. Now, on a balance of probabilities, from our perspective, we see a higher probability of yields falling further, just given the underlying uncertainty in terms of how tariffs are going to impact in particular markets. If you think about Australia in particular, we know that the trade balance was quite weak in the latest GDP print. Now, a key barometer for that was obviously subdued demand coming out of China. So if we do continue to see that coming through, we could see potentially long end of the curve yields come off. Now, a way to capitalize on that movement is increasing duration. So when yield prices come off, you get the uplift coming through. So that's the key premise for, I guess, adding duration. But having said that, not extending too much because of the underlying volatility of day-to-day changes in yield as well. That's something to also consider.
Cam, no doubt an important backdrop for the conversation that we're about to have. So let's move to the solutions. We're going to talk about three today. I'll give the tickers first. So there's EBND, Sub-D and Lend. Let's start with EBND, which is the Emerging Income Opportunities Active ETF. Just take us to the first level, Cam. What exactly does EBND do?
Yeah, so EBND is our active emerging markets bond ETF. It is managed by our US colleagues. Eric Fine's the lead portfolio manager on that particular strategy. He was in Sydney just recently, obviously talking up his strategy. And if you think about its performance over the last 5 years in particular, it's been the best performing ETF, bond ETF in the market. So if you think about emerging markets, particularly for Australian investors, it's really an unknown asset class to a lot of people. And one of the key things that we're trying to really reinforce is that emerging markets have matured over the last 25 years. They typically had current account deficits, so they were, I guess, relying on overseas investments coming into emerging markets. But we've seen a reversal in that trend. They're actually net lenders to other parts of the economy. So in terms of their, I guess, fiscal breakdown in terms of government spending, it's become a lot more prudent. And if you look at the yields that are out there, so the ETF at the moment is offering around an 8% yield. That's quite attractive, considering if you think about developed markets, and in particular the US, in terms of how they're going to tackle, how they service the ever-growing amount of US government debt. Now it does, in terms of emerging markets, it invests across both government bond, emerging government bonds, and corporate bonds. It's predominantly in the government bond space. And it's investing roughly 50-50 in hard currency bonds, so bonds issued in US dollars, and also local currency bonds as well. So it's quite a nuanced strategy. And certainly when you think about the asset class, given the nuances around how you think about Brazil, how you think about China, how you think about some of the, I guess, more of the, frontier markets in Europe in particular, certainly being active makes sense for that asset class.
Yeah, it's a really interesting point that you touched on, Cam, and I've heard Eric make it before. It seems like these emerging markets have been far more fiscally responsible than a lot of other countries, particularly in the Western world that you were talking to, and they've got their houses in order, and we seem to keep inflating away and taking on more and more debt here in the West. So yeah, fairly attractive market and really interesting that it's had such stellar performance. For those playing at home, Cam, how close are those investments to hybrids? Or how do they replace or substitute for the hybrids that are being phased out? And how are they the same and how are they different?
If you think about hybrids, they're sort of a mix of debt and equity instruments, whereas this particular ETF's only investing in emerging market bonds. So from that perspective, it's quite different. Obviously, the asset class and the geographical exposure is quite unique in that regard. They're also typically fixed rate in terms of the bonds, whereas we know ASX hybrids are floating, so you are getting more, I guess, portfolio duration coming through. And if you're looking for more of a diversified offering, so if you're looking at a range of asset classes across fixed income, emerging markets certainly have shown their worth over the medium to long term.
Cam, we've talked about the excellent performance. What is the target return though, and what are you actually aiming for?
Yeah, so no, I guess, explicit target return, but having said that, is looking to outperform the benchmark. It's a JP Morgan 50-50 benchmark that tracks the performance of essentially hard currency bonds and local currency bonds. Now, Eric makes the discretion to, choose the bonds that obviously go into the portfolio, but also going whether he wants to go overweight local currency bonds or underweight, and vice versa in terms of hard currency exposures. So it's quite a nuanced strategy.
All right, Cam, let's change gears now. We'll focus on Sub-D, which is the VanEck Australian Subordinated Debt ETF. Same question up front. What does it invest in?
So pretty, straightforward. So it's investing in Australian denominated subordinated debt bonds. The ETF is the largest on the ASX. In terms of AUM, it's about $2.5 billion. It was established back in 2019 when APRA actually announced for the big four banks that they needed to increase their capital allocations to tiers. So that was a key premise for bringing this particular ETF to market. It's been quite a popular ETF over the last 2 years in particular. It was one of the, I guess, top in terms of net flows, one of the largest in the fixed income space. One of the key things to note as well is that in terms of the underlying portfolio, it's investing in subordinate debt bonds issued by the big four banks, Macquarie. It has some Australian insurer names in there. And what we've recently seen, particularly over the last 18 months, is offshore foreign banks issue subordinate debt into the Australian market. Now, a key premise for them doing so has been obviously the growth in the broader T2 market. So they know that, I guess, the Australian market's obviously got appetite for that paper. And the key benefit for Australian investors is that those foreign banks issuing bonds in the Australian market provide a yield pickup of around 50 basis points. So from that perspective, it's quite compelling on a I guess relative basis as well.
Cam, talk to me about where subordinated debt sits in the capital stack as compared to AT1 hybrids, and then again, what are the similarities and differences between the two?
Yeah, so subordinated debt, it sits one notch above ASX hybrids. And in terms of, I guess, a yield to return profile, it's probably the closest fit that you can get to gaining access to, I guess, ASX hybrid-like returns. Yep. And if you look at the yield differential between where yields are of ASX hybrids to subordinated debt, the differential is about 60 basis points at the moment. That's including franking, which is, I guess, quite compelling. And that's actually historical lows if you look at it on a 5-year horizon. So from a relative sort of risk profile perspective, subordinated debt relative to ASX hybrids look quite compelling from that point of view. And that's obviously probably the most natural fit for investors looking to replace their existing ASX hybrid exposures.
Thanks, Cam. Again, just take me through the target return, and then how has the ETF been tracking against its target recently?
Yeah, so it's a passive ETF, so it tracks an iBoxx subordinated debt ETF. It only invests in Australian denominated subordinated debt, also floating rate paper only. So in terms of when you think about ASX hybrids, they are floating rate. So you're getting a similar, I guess, profile to that as well.
All right, Cam, last one on the list. We'll talk about LEND, L-E-N-D. It's a great ticker code. It represents the global listed private credit ETF. What does LEND invest in?
Yeah, it's a very interesting strategy. We launched it just over 12 months ago. Now, certainly private credit, both in Australia and globally, has garnered a lot of attention recently. Obviously, there's a range of reasons for this. What we're seeing really since the onset of, or following the global financial crisis, is that the traditional banks have had to step away from those, I guess, private credit lending arrangements, which is where the reason why private credit more broadly has grown over the last 15 years. Now, one of the key attractive features of private credit is obviously the yield profile. LEND, for example, it offers a yield above 10%. It's one of the few asset classes that offers such a high yield. Having said that, it is commensurate with its obviously risk profile. Now, one of the key things to note about LEND is that it's investing in global listed private credit. So many people would be familiar with some of the LITs or LICs in the Australian market. It's effectively the equivalent in offshore names. Now, in terms of companies or listed companies that come into LEND, our index provider needs to see sufficient look through in terms of the underlying profile of those instruments. Now, the listed companies, in the underlying exposures, more than 90% of those is in direct lending. Taking a step back, LEND only holds, they're called US business development companies. Yep. Now, the reason, say, the likes of some of the Australian names aren't in there is because the regulatory requirements, it means that they don't necessarily have to disclose their underlying holdings. Right. Whereas the key premise for being included is that they need to disclose the underlying holdings, so the underlying loans that they're actually investing in. So the BDCs on a quarterly basis are disclosing that. And you can see on their website, the types of, I guess, borrowers that they're lending to. And that's the key differentiator for I guess, this particular ETF. Now, in terms of the underlying loans as well, they're typically giving loans to more services-based industries, whereas the Australian market in particular is more, I guess, focused on real estate development. So that's quite a key differentiator as well.
Yeah, Cam, no doubt. It's definitely important to have that transparency when investing in private credit markets across the board, I guess you'd say. Again, Cam, talk to me about how close this gets to not replicating, but sort of substituting AT1 hybrids. What are the similarities? What are the differences?
Yeah, so I guess, both instruments, I guess, are on exchange in terms of access. These, obviously, the profile is very, very different. These lenders are providing loans to, they're called middle market companies, so companies that can't access your traditional, I guess, avenues for borrowings. So that's clearly different. And obviously the yield profile is quite substantially different, being a yield of above 10%, whereas hybrids around 5.5%. And in terms of some of the underlying underlying exposures and so forth, you're getting more exposure to US centric names. So clearly, quite different. One of the, I guess, points to consider is that the majority of loans that are given are actually in floating rate exposure, which is similar to ASX hybrids.
Yep.
So that would be, I guess, one sort of simulator to think about. So if you're more concerned about interest rate duration, but I'm, I guess, more comfortable with potentially taking on more credit spread duration, then lend could be an area to consider.
Yeah, so I think it's fair to say this one's a bit higher up on the risk curve, but obviously the expectation is that you're going to be rewarded with greater return for the higher risk that you'll take as compared to AT1 hybrids. So good to know. Just on that, Cam, what is the target return and how's the ETF been tracking since it's been launched?
Yeah, so it's a passive ETF. It tracks the index providers called LPX. They're very, experienced in analysing the underlying, in particular, listed business development companies. Very, very reputable in the space. And in terms of the income distribution for lend and also our other ETFs, is to provide, in terms of the distribution yield on the ETF, to be reflective of the underlying income coming into the underlying portfolio as well. Yep. So the yields at the moment, it's around 10%.
So Cam, as we've just been talking about, there's no direct replacement or replica for AT1 hybrids. And I know you can't give personal advice, so I'm certainly not asking for it. But obviously VanEck has a suite of products, and these products come close to replicating or filling the hole, shall we say, that some investors might be facing with the phase out of AT1s. So yeah, could they select one or multiple of these products and try to help fill that hole that might be in their portfolios?
Yeah, there's a range of options that I guess VanEck in particular offer in terms of ETF offerings. The natural fit would be subordinated debt, given it's one notch above in the credit stack, and in terms of the yield and also duration profile being, I guess, the most similar to ASX hybrids. Now, if you're looking to build out a more diversified, low duration credit portfolio, then I guess potentially a mix of subordinated debt, potentially lend if you're comfortable with that risk profile. There's also senior corporate paper, both in a floating rate and a fixed rate exposure. So we have FLOT, which only invests in senior corporate floating rate paper. For example, it tracks the market benchmark. It's the AusBond index. So yeah, there's a range of options, and if you're looking to, I guess, potentially add more, I guess, portfolio duration into your portfolio to potentially capitalize on further falls in long-dated yields, then potentially EBND is something to consider.
So Cam, just a question without notice there. I'm a bit older than you, and gone are the days where income investing was pretty one-dimensional. You just buy a couple of income-generating stocks, maybe some government debt. Now there's this broad range of opportunities, broad range of ETFs even that VanEck provides. But I think the important thing is making sure that investors understand, what's in those vehicles and the risks that come with them. So where can people go to find this information? Can they go to the VanEck website to get quality information about, the products that you guys offer?
Yeah, it's a great point of reference. Certainly, looking at our website or speaking to a financial advisor or broker for specific advice in terms of your investment needs there are a few avenues that you can explore.
Thanks, Cam. That's good to know. Appreciate you sitting down with Livewire today and taking us through the different options that VanEck provides.
Thank you, and appreciate your time, Chris.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.